By this point in the series, you have strengthened your structure. You understand margin. You understand diversification. You understand leverage. Now we introduce something even more important. Allocation discipline. Because expansion without allocation logic quickly becomes scattered. Many people earn more money over time. Some manage to save. But very few allocate capital deliberately. And allocation decisions shape long-term position. Whenever surplus appears, something interesting happens. Several priorities compete for the same capital. Liquidity wants funding. Assets want funding. Lifestyle wants funding. Opportunities want funding. Without a framework, impulse usually wins. So we introduce a simple model. The Capital Allocation Grid. This is not designed to complicate decisions. It is designed to clarify them. Every allocation decision can be evaluated across 4 dimensions. First, impact on structural resilience. Second, impact on income capacity. Third, effect on liquidity. Fourth, rigidity introduced. Let us define these carefully. Impact on structural resilience asks, does this strengthen my survival position? Impact on income capacity asks, does this increase my future earning power? The liquidity effect asks, does this preserve accessible capital? Or reduce it? And rigidity introduced asks, does this increase fixed commitments or structural obligations? Now pause. Open your workbook. Create a simple scoring table. For any surplus decision, score each category from 1 to 5. 1 meaning low impact. 5 meaning high impact. Let us examine a simple example. Imagine you have £10,000 of surplus. One option is a vehicle upgrade. Structural resilience. Likely low. Score perhaps 1 or 2. Income capacity. Minimal. Score 1. Liquidity effect. Liquidity decreases. Score 1. Rigidity introduced. Higher insurance or payments may appear. Score perhaps 4. Now compare that with skill expansion. Structural resilience. Moderate. Score perhaps 3. Income capacity. Potentially high. Score for all 5. Liquidity effect. Depends on structure. Perhaps 3. Rigidity introduced. Minimal. Score 1. The grid makes trade-offs visible. Not emotional. Visible. You are not banning lifestyle choices. You are simply ranking options. Over time, higher scoring allocations compound. Lower scoring allocations may still occur, but consciously. This changes something subtle. You are no longer reacting to surplus. You are evaluating surplus. Now reflect quietly. Think about your last significant surplus decision. If you applied this grid, what would the scores have been? Would you have chosen differently? Write that down. Capital allocation is where long-term position forms. Most people earn. Some people save. But relatively few allocate deliberately. An allocation discipline separates comfort from structural power. In the next episode, we will consolidate Season 4 into a 5-year positioning framework. Because expansion must connect to time horizon, not just opportunity. If you would like to apply this framework properly, download the Capital Allocation Grid template. Use it whenever surplus appears. Clarity improves when decisions are written down.